You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and today is the last day of November 2021. Well, we had a real Black Friday last Friday. It took all of the pundits by surprise. Except for the person you're about to hear from. He's not surprised by anything, not after 4 decades being in the investment industry, being a veteran. His name is Gil Baumgarten, and you find him at segmentwm.com. Gil, great to have you back.
Thanks, Kerry. Glad to be here.
Hey, so we had a real Black Friday last Friday. Volume up dramatically. It surprises me because most of the traders are gone day after Thanksgiving.
Yeah.
They didn't even have the B team or the C team at the trading desk. They had the D team and the E team.
Yeah.
And it makes you wonder, how does this happen other than it's got to be triggered by algorithms?
That's what I would think. And, everything is so automated nowadays. The specialists have all been pretty much put out of business. And there's an electronic, market maker order matching that's going on. And, you end up with more sellers than you have buyers. And that's what happens. Price momentum swings the other direction.
Yeah.
Today is more of the same.
Yeah. So like you look at it and you say, how can this be? Because if there were like human beings at these terminals, I'm dating myself, workstations, of course.
Yeah.
If there are human beings there, you can have crashes. But the fact is, that most of the human beings were out of the office Friday after Thanksgiving. Yeah, the hardcore dedicated traders, they're in their house at their notebook or their desktop, whatever, trading away. But for the most part, all of the buys and sells are algorithmically generated.
Yep.
Not generated by human beings. And I think this is something that has not been examined close enough or studied. Yes, there was bad news on the health pandemic front. Apparently bad news. We don't really know how bad.
That's just a triggering event, though.
Yeah.
Yeah. So, that's what kind of set it off. It's kind of reminiscent of what happened in May of 2010. Remember that when we had that flash crash? I think the market was trading at 13,000 at the time and was down 1,000 points in about 15 minutes. And it was pretty crazy. Recovered a lot during that day. And we've had some recovery already and then some sell off again. So been pretty nasty here the last 3 trading days.
Yeah. So can we learn something about what's going on in the markets other than they've been hit? Is there something there that the experts aren't seeing? Is it just a couple week correction? We finally get a 20% correction, which we haven't had in ages, or is it something deeper?
I think the reality of inflation is starting to set in and people are starting to get a little bit concerned. The market has a hard time generally going up during times of inflation. I don't know how transitory that's going to be. There was some news earlier today that the Fed wants to change their transitory language to something more permanent. So, of course, that's a little bit bothersome for the marketplace. Some of that news was probably coming out on Friday, and there were people trying to get out ahead of that. And you just have mechanized trading that just sort of crescendos in these types of sell-offs. And I think we're going to have more of them. So it's the lesson, which was your original question, is not to chase momentum. If you are a position builder over time, you're going to average in during some of these sell-off periods. But if you're chasing the market into new highs, especially if you're doing so with borrowed money on margin, you can really get your tail on a crack. And I think there's some of that that's happened here recently.
All right, here's a question for you, Gil, and I know you know the answer. Is it better to average up or is it better to average down?
Always better to average up. Yeah, Warren Buffett puts it this way. He says, don't cut your flowers so you can water your weeds.
I like that one, and it's a very apropos. Obviously, you're better off averaging up, but people will say, well, when you're averaging down, you can buy more.
Yeah, but a lot of times the stock has something or a company has something wrong with it that you didn't anticipate, and you start to average in before all the bad news is known, and you end up, with your hat in your hand. So averaging up is always better than averaging down, although it's not intuitive to believe that. So that's what we have to fight against, is our natural inclination to see every downdraft as a purchasing opportunity. I think that's only true in the broad market, where averages can apply. In individual securities, it gets a lot more treacherous because there's information that you cannot necessarily know.
All right. So then the other question I have for you is dividend stocks, the so-called dividend aristocrats, and other stocks like Apple that are starting to increase their dividends because they're making so much money, they can't even figure out what to do with it other than stock buybacks. But personally, I prefer to see it go into dividends. How badly do dividend plays get affected in this type of market, Gil?
I think the ultra high yield dividends get hurt. We run a rising dividend tax efficient portfolio at my firm, Segment Wealth, but we don't chase high yield for the sake of high yield. We have a very average dividend yield at best. What we're after is companies that have a history of paying more every year, not having a high relative dividend. If you look at the high relative dividend and the dividend aristocrats, that index has underperformed the broad market for some time. That money has to come from somewhere. If AT&T is paying out a 6% dividend, that comes at the forsaking of something else. So normally growth and low cost of borrowing and other things that are kind of a carry-on effect. So,
all right. What about dogs of the Dow with a dividend strategy? Because the dogs of the Dow have proven over time to really put in a pretty good, solid performance.
Yep.
And you're getting paid to hold the dog. And
that's right.
And the whole concept of buying these Dow company stocks is that they're large cap stocks, so they're more able to weather economic downturns. And for the stocks that aren't doing well, because they've got the financial wherewithal and the strength, they're probably going to turn around. Now, obviously, you have your Kodaks and your Xeroxes who've just kind of faded into oblivion. But a lot of companies, the dogs, 6 months ago, Exxon was a dog of the Dow, right?
That's right. It is sort of a anti-momentum indicator. Buying the weakest of the industrial stocks. You're correct that the dogs of the Dow, for all your listeners, is about really just buying the highest yielding of the 30 Dow components, which is typically driven by price. Since dividends are fixed, the payments are fixed, the lower the price goes, the higher the imputed yield is. And so buying the 10 off the bottom of the list of which would generally be the worst performers on top of the list of the highest yielders has proven to be a pretty good strategy over time. I would sort of liken that to something more like Berkshire Hathaway, which is one of the largest positions at my firm, which runs its own sort of a value metric and also has not done particularly well relative to the market here lately. So Berkshire, I think, would be a great place to put money. Berkshire is also more tax efficient than owning the dogs of the Dow, because the dogs pay a yield out that you, in fact, have to pay tax at up to 23.8%. Berkshire Hathaway doesn't pay a dividend, and they have the ability to move capital around amongst all the businesses that they run, seeking the most efficient outcome. So it's just another way to play sort of the same theme.
Hey, so I'm looking at the dogs of the Dow. This is just Investopedia's 2021 dogs of the Dow. And I'm not asking you to recommend anything, obviously, but number one on that dog chart is Amgen. They're paying 3.06%. Chevron, and I don't know how current this is, I have to confess, they're number three. They're paying 6.11%.
Yep.
Dow Chemical, 5. IBM, which I wouldn't touch with a 10-foot pole, but for other reasons, because their revenue deterioration, their top line growth is just not there. They're at 5.18. Coca-Cola's there. Verizon, Walgreens, you look at this and you say, wow, these companies could easily turn around for the most part, couldn't they?
Yes, but you'd be averaging down if you were going into that strategy. Averaging up would be buying the Apple computers and the others that have a lot more momentum. So we're not big on buying the dogs of the Dow stocks. We would rather buy the lower yielding ones that have a lot better price momentum and have a lot better financial metrics. On our list, it would be Apple and Medtronic and Stryker, Accenture, Home Depot. Those are the kind of names that we own in our rising dividend philosophy.
And right as we speak, Apple's yielding 2.33%. So It's not keeping up with inflation, either the stated rate or the real rate of inflation. But on the other hand, it has potential price appreciation. And I guess you pay a price for it's still a growth stock in some way or form.
And it's way better than buying the Apple bonds, because you could loan money to Apple and earn less than 1% on your money. The interest that you would earn would be fully taxable at ordinary income tax rates, and you would get your money back in the future, as opposed to Apple stock, which of course you don't know what the future value is, but you're getting 2 times the dividend yield than you would earn in the interest on an Apple bond, and the dividends that you receive are 77% tax free because you're capped at a 23.8% tax rate, so 76% tax free. So we like Apple stock.
Okay, here's a stock, everybody's darling, the market darling of the day, and I believe there's always a bellwether stock that really sets the tone. And you know what I'm talking about? TSLA, right now trading at 1138.50.
I thought you were going to say NVIDIA.
Yeah, well, but Tesla's really the bellwether, though.
Yeah,
it's performed so fast. It's growing by leaps and bounds. Whether it'll continue that way, who knows? But what's your take on that? Is it too late to get in? Has the party come and gone?
Don't just survive, thrive. The Financial Survival Network.
Trilogy Metals is a world-class developer in Alaska's Ambler Mining District. The company already possesses 8 billion pounds of copper, 3 billion pounds of zinc, over 1 million gold-equivalent ounces, and now over 77 million pounds of cobalt. Trilogy's Arctic project boasts an after-tax net present value of $1.4 billion with a 33% IRR. Trilogy is led by an experienced management team with proven success in discovering and developing projects in Alaska. The company is well capitalized, has no debt, and possesses strong institutional support. Trilogy trades on the New York and Toronto exchanges under the ticker symbol TMQ. To learn more, go to trilogymetals.com. That's trilogymetals.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
We are just not fans of it. And I have to admit, we have totally missed the boat. I actually shorted the stock 2 years ago in my own account at around $200 a share. I bought it back at $150, got really lucky making $50 in it, but man, I should have been long, and I've been totally wrong on that one. So I'm no Tesla bull, but it probably will go higher. It seems to be the direction that everything wants to go, is towards electric, but I'm not so sure they're not going to have a ton of competition from Volvo, which says by 2025 they're not even going to make a piston engine. So the whole world is shifting, and I'm not so sure that Tesla is going to be able to continue with so much more competition.
Well, that's what they've been saying all along. Really, Tesla is 5 to 10 years ahead of everybody else in terms of technology, in terms of build quality and grade. Prejudice, I've got a Tesla. In terms of build quality, they're 2-3 years behind the leaders. They could definitely do a better job there. But in terms of functionality, technology, the car is just a computer on wheels, and
it is
absolute brilliance.
A friend of mine bought one in 2011, and we went for comparative test drives, and I really didn't even know what it was. I knew it was an electric car, but I had no idea how fast it was. And my contribution was that I was going to take him for a ride in my rear-engine Ford GT. And he was going to take me for a ride in his electric Tesla, which I think was the P90D. And I was blown away at how fast that thing was. It just totally took me off guard. My mouth was just agape. I could not believe how fast it was. And I frankly think it was faster than my Ford GT, which at the time was one of the fastest production cars that they made.
See, that's what the market doesn't exactly perceive. I mean, you see the videos and everything else, but basically Tesla is a supercar.
Yes.
And mine, I've got the Model 3 long range. And look, it's not as fast as the Performance, not as fast as the Model S, certainly not as fast as the Plaid, the Model S Plaid. But, you know, the cars come up and they want to race you, and it's like in 3 seconds, it's over.
Yes.
It's an amazing vehicle that the propulsion, the way that it goes with no transmission, you know,
it's instant torque. Having the drive source right at the wheels and the responsiveness of an electric motor. Yeah, all of us have seen little bitty electric motors that drive all kinds of things where you hit the battery and it's going 100,000 RPMs or whatever it is. It's just instant. And, combustion technology just can't do that, especially with a turbocharger, which has a load up time. I drive turbo diesel cars. I'm on my 13th diesel car, and I love diesel. It's just the opposite of responsiveness when you compare it to electric.
Yeah, well, diesels, I've rented them many times in Europe, and they're interesting, but I think they've seen their day. But the idea, like Tesla, simple thing, do away with keys. Who needs a key anymore? Use your phone, and you have a transponder card. And you program them on the fly. You don't have to pay Mercedes-Benz $250 because you lost the stupid fob. So many things that they do. Their sound system is superior to any other sound system I've ever seen in a car. I didn't mean to make this about Tesla, but the point is, you could love the car and hate the stock, because at some point, Benjamin Graham said that, it could be a great company, but at some point, the price of the stock makes it not an investment, but a gamble or speculation.
That's right.
And that's where we're at with Tesla. And those who have speculated well, it's great. They've done really well. But successful investing generally requires some type of discipline. And a disciplined investor wouldn't be investing in Tesla.
Yeah, that's true. We've missed the boat on it. Instead, we were talking about NVIDIA earlier. We do have a nice position in NVIDIA, which has a similar kind of a 2-year growth rate to Tesla. And it just made a whole lot more sense to me as to why I would want to own that. So
yeah, well, NVIDIA is a play on crypto mining cryptocurrencies.
That and the gaming marketplace. They're the number one maker of chips for gaming. So yeah,
gaming marketplace huge. The combination of the two, and you really got something. What's NVIDIA done in the past 6 months or so?
I think it's up 150%.
Not bad. Yeah. Not a bad return.
Yeah, let me double check that. I got it right here. So it's 323 today. It was 210 on October the 7th. So, and then it was 195 in July. So that gives you some idea right there.
Yeah, nice. So looking ahead, increased volatility. Do you play the VIX or do you fund the VIX?
I really think buying the VIX, VIXY, is a good idea. Just don't hang on to it for a long time. A lot of degradation in that. And I'll have to also give the caveat that most every time that I've bought VIXY, I've ended up losing money. I might have been right for a little while, but I always hang on to it for too long. I don't seem to be to have a golden hand when it comes to that one. I've sure tried to play it before. Seems to make sense, but it's a tricky one to play.
It's kind of like the story of the guy and his wife go to Vegas, and she's playing blackjack and she loses $200, and he's really, really upset. And says, "How could you do that? Don't you know what you're doing?" And she goes, "I lost 200. You lost 2,000." I said, "Yeah, I knew what I was doing." So,
yeah, exactly right.
Yeah, you knew what you were doing, and you got burned. But for the
That's right.
innocent babes, man, they could buy GameStop. I was at the mall the other day and I was really surprised about something. I passed by the GameStop. There were people in there.
Yeah, it is surprising.
I was really shocked. I said, I didn't think anybody, everybody's online. You play the games online, you buy them online. Why would anybody go there? But some people were finding reasons to go. Maybe they own the stock and they just wanted to see if the company really existed.
I still think the play is energy. We talked about this last time, a month or so ago when I was on your show. It has definitely gone our way. This last little downdraft, I think, will eventually be caught back up. And so I still think energy is a great place to be.
Energy metals, battery metals, right? Copper, nickel, lithium.
Yep.
They've all had tremendous runs. Because what people don't understand, if you're just an investor, is, hey, copper is great. Like we got enough, almost enough right now, not quite, but almost. But if all these grandiose plans for the green future actually come to fruition, got a big problem because it takes 12 to 20 years to build a major copper mine just about anywhere in the world because of the way regulations are now. Because of communities don't want to mine in their backyard, even though you're going to save the planet, all these great things. And at the rate we're going, we're just not going to have enough copper and nickel and lithium and cobalt, and just go down the list. They're like sure things, assuming that the forced trend of electrification continues onward. And the only reason why it wouldn't is because the governments of the world, or the elites, actually recognize the fact that it just isn't going to work.
Yeah, that's what I'm with you on that. And we've chosen not to play that as much as we have chosen to play the major oils. We own XLE, the energy ETF. We own XOP, which would be the smaller energy ETF. That would, by smaller, I mean it's going to be the Diamondback and Callan Petroleum, that group, rather than the majors of Exxon and Chevron. Those are, I think, still a great place to be.
All right. Well, it's the energy, because again, the same policies that are pushing for shortages in the battery metals are pushing for shortages in energy.
Absolutely. And our national policy has seemingly not changed with regard to what's causing some of these price dislocations. And it sure seems that that's going to favor higher energy prices in the future. So,
yep, couldn't agree more. Well, I think we covered enough. Just tell us again, Gil, best place to find you, connect with you on the web.
Yeah, segmentwm.com. I also write a blog, which would be same, segmentwm.com/blog. And my book is also on Amazon, Foolish, How Investors Get Worked Up and Worked Over by the System. So your listeners can take a look there.
All right. We always appreciate your input and your contributions, Gil.
Thank you.
Hope you had a great Thanksgiving and coming holidays, and we will talk to you again soon. Got a question for Gil? Just shoot us an email to kl@kerrylutz.com. And don't forget, go to our site, Financial Survival Network. Sign up for your free newsletter. Gil, always a pleasure. Thank you so much.
Yes, sir. We'll see you.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.